In this video, we're going to look at General Mills, those great cereals you eat in the morning. Now, what I do in my videos is I run my discounted cash flow model to figure out the true stock price. We also look at the financial ratios of the company to get more information. And I do this with you on a video, so it's like we're doing it all together. So let's get started with the model. This company has a market cap of $39.5 billion. And that's how much money the company is worth, according to the stock market. And let's see what they're trading at. They're trading at $64.79. So that's how much it costs to buy one share of stock. Now we're going to pull the free cash flows. And the way you value a company is you estimate the future free cash flows. Then you discount that dollar amount back to today's value. And that's exactly what I'm doing here in the video. Now I'm going to pull the net income, which is the profit and loss on the income statement. And we usually pull 4 years of data for the model. And then I'm going to pull the revenue, which are the sales for the company. And you want to just make sure the numbers look pretty consistent and positive. It looks pretty good, so we should get a good value. When the numbers are all over the place, we might not get the best estimate of the stock value, but if they're consistent, then we should get a good value and it should work for the model. Let's look at the capital structure of the company to figure out what discount rate to apply to the future cash flows. So they pay $472 million of interest on their debt. That's on the income statement. We'll go to the balance sheet to see how much debt they have. So current debt of $2.6 billion. That's debt due within 12 months. And long-term debt of $11 billion, that's debt due after 12 months. They pay 3.5% interest on the debt. Interest payments are tax deductible, so let's get their effective tax rate. We'll go back to the income statement. Income before tax is $2.6 billion. Then income tax of $480 million. So they pay 18% in taxes, so the cost of debt is 2.8%. To get the cost of equity, we need the beta, and the beta is how much the stock moves relative to the entire market. So this has a low beta of 0.58, so the stock moves half what the market moves. So if the market went up, say 10% in a given year, this stock should go up about 6%. The lower the beta, the lower the weighted average cost of capital, and the lower the discount rate. Let's go back to the balance sheet, because we need some information to calculate the current ratio later. So we need the current assets. These are cash, accounts receivables, and inventory. That's $5.1 billion. And current liabilities is what the company owes within the next 12 months. That's $7.5 billion. And let's pull their equity. We need this number when we calculate the ROE later. And equity is assets minus liabilities. That's $8 billion. And their EBIT, we need the EBIT when we calculate the interest coverage ratio later. EBIT stands for earnings before interest and taxes, and that's $3 billion. So let's look at the capital structure. So the company's cost of debt is 2.8%, and they have 63% debt. And the cost of equity is 6.8%, and they have 37% equity. So the WACC is 4.3%. That's a blend of the cost of debt and cost of equity. So that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value for the company of $59 billion. We divide that by 610 million shares. And we get an intrinsic calculated stock price of $98. They're trading at 65, so they're trading at a 34% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're valuing them at $75. So a little lower than what I'm valuing them at. Simply Wall Street uses 4 different types of models to value a company. And I think they mainly use their discounted cash flow model like I use. But they also have a dividend discount model and some other models. Let's look at the historical stock price. So the stock was trading close to like $75 a few years ago. Then it's dropped. But it looks like it's been on an incline. Even during coronavirus, it's still been increasing. So this stock probably won't get affected too much by coronavirus because people need to buy food and cereal, of course, especially if they have kids. Let's look at the financial ratios. They have a decent PE of 18.1. I like to see under 15. This is price to stock over earnings per share. They have a good price to sales ratio of 2.2. That's price to stock over sales per share. A little high price to book at 4.9. That's price to stock over book value per share. Their current ratio is below 1, so they cannot cover their current liabilities. So we should look at the following quarters to see how the current ratio develops. If it stays below 1, they're going to have to take on more debt. And they're already at 63% debt. So that's not a good sign. They have good ROE at 27%. That's income over equity. That's how much value they're providing their equity holders, their investors. They could easily cover their interest payment more than 6 times. So the company looks like it has solid ratios and it's valued at a good buy. For more mature stocks like this, investors aren't as willing to pump the price up like they would for a stock like GIS or WIMI, newer companies, smaller companies. These are more larger companies and people want a quick return. This is more of a long-term play, but I think it's definitely a safe and secure bet for any investor. Thanks for watching the video. Please leave a comment.